Hi dear traders, the data on the US labor market confirmed the Fed's intention to continue its aggressive monetary policy. US stock indices closed sharply lower last week, while the US dollar managed to win back some of its losses and return to 20-year highs. At the close of the week, the US dollar index gained 0.73%. As we have mentioned above, the value of the US dollar against the basket of 6 major currencies, which is what the US dollar index is, has tested a 20-year high at 109.75. US non-farm payrolls showed that the non-agricultural sector added more new jobs than expected, while the unemployment level suddenly rose and average hourly earnings slowed down. This data suggests that the US Federal Reserve will raise the rate by 75 basis points at its next meeting in an attempt to tackle inflation, even despite the threat of recession. Recession fears are unlikely to stop the European Central Bank either. The monetary authorities are very likely to introduce a rate hike of 75 basis points this Thursday. This is a very bold step given the dire state of the European economy. In particular, the European Union is on the brink of a massive energy crisis, especially now when the Nord Stream pipeline has been shut down for maintenance and it is still not clear how the turbine will be delivered back amid the European sanctions. Investors are pessimistic about the future of the Eurozone, which can be seen in the trajectory of the euro-dollar pair, which continues to trade near the parity level. The British pound is also heading for the parity level against the US dollar. The pair lost 2.14% over the last week, having tested the low of March 2020. Investors are getting rid of the pound. Inflation in the UK has reached its peak in 40 years and shows no signs of a slowdown, unlike that in the US. It continues to accelerate, fueled by soaring energy prices. Things might get even worse in winter. Of course, the Bank of England has to act, and it is expected to raise the rate by 50 basis points at its next meeting. However, traders keep in mind political uncertainty in the country ahead of the Prime Minister election. As a rule, demand for safe haven assets goes up amid economic turmoil. Yet, judging by the dollar-yen pair, traders prefer the currency with less protective qualities, the US dollar to the yen. What's more, the pair has reached a 24-year high of 140 yen per dollar. The reason behind this is the difference in the policies of the two central banks. Japan insists on keeping rates low even though inflation is rising there as well. Japan's monetary authorities see a price increase as a temporary factor that will disappear next year. As for the other safe haven assets, gold also stays under pressure. US government bonds seem more attractive now ahead of the rate hike by the Fed. Last week, the precious metal tested the support level of $1,700 per troy ounce. In the commodities market, oil was also controlled by bear traders last week. Brent crude fell by 7.5%. The trading instrument seems largely oversold and requires an upside correction. However, at the moment, no fundamental factors can support this move. Oil traders were upset by the manufacturing data from China. The world's second largest oil consumer signals a slowdown in production and lower demand for energy amid a looming global recession and new coronavirus lockdowns. On Friday, China announced a lockdown in Chengdu, a city of 21 million people, due to a new outbreak. In addition to that, negotiations about the nuclear deal with Tehran are still going on. This may potentially return Iranian crude to the oil market, thus increasing supply and putting more pressure on oil prices. These are the trends of the last trading week. We will keep providing you with the most relevant information. Don't miss our traditional weekly review, which is due tomorrow, as well as everyday news reports. See you online soon.